Stablecoin regulation is not just a legal concern. It shapes how products are issued, distributed, redeemed, stored, and trusted. In this section, we'll translate regulatory requirements into practical design choices that affect customers, operations, and enterprise adoption. So far, we've built the foundation: the regulatory landscape, the emerging rules for stablecoins, and the economics behind issuer models. Now we shift from analysis to product choices: how regulation and business models shape what teams actually build. After that, we'll go deeper into risk and compliance. A useful way to think about stablecoin products is this: regulation does not stay in the legal department. It becomes part of the customer experience. It shapes who can onboard, what disclosures they see, how funds are held, when transfers settle, and how redemption works. The business role matters too. Issuing a stablecoin creates different obligations than distributing one, integrating one into an app, or providing custody. Strong product design connects these choices to user needs, so trust is visible, controls are reliable, and compliance does not create unnecessary friction. The first strategic choice is not technical. It is deciding where you sit in the stablecoin value chain. An issuer owns the asset design, reserves, redemption, reporting, and the heaviest regulatory burden. A distributor gives customers access to an existing coin, usually through a platform, exchange, or fintech channel. A wallet or custody provider focuses on safekeeping, transfers, controls, and user access. A payment integrator embeds stablecoins into checkout, treasury, or marketplace flows without necessarily creating or custodying the coin. Each role can be attractive, but each changes the revenue model, risk profile, compliance workload, and capabilities required. Issuing your own stablecoin means controlling the full loop: accepting funds, holding reserves, minting tokens, supporting transfers, and redeeming back to cash. That control creates product upside, but it also creates operational burden. Every token needs a credible claim on high-quality reserves, clear redemption rights, and dependable burn mechanics. The hard part is not just launching the token. It is maintaining trust during stress events, fraud incidents, audits, and regulatory reviews. Strong issuers treat governance, disclosures, licensing, banking relationships, attestations, and support capacity as core product features, not back-office afterthoughts. Many companies do not need to become stablecoin issuers. They create access by distributing, accepting, or routing payments through partners. In this model, the critical design choice is where responsibility sits. The platform may control the customer experience, checkout, reconciliation, and support, while the issuer and reserve partners control issuance, redemption, and backing. That makes partner due diligence a product requirement, not just a legal review. Teams should test reserve transparency, redemption reliability, jurisdictional fit, and service levels. Users also need clear disclosures about who issued the token and who stands behind redemption. Wallet and custody design comes down to power and responsibility. In a custodial model, the provider manages keys, recovery, and often compliance controls. That can make access easier, but it also raises operational risk. Non-custodial wallets put control with the user, so education, warnings, and recovery planning become critical. For enterprises, neither model is just a login screen. It needs permissions, approvals, limits, and audit trails. Good wallet design makes fees, balances, transaction status, supported assets, and redemption choices clear before users commit funds. Redemption is where stablecoin trust becomes practical. A user asks to convert tokens back to fiat, but the issuer must first confirm eligibility, KYC status, minimum amounts, and any limits. Then the tokens are burned or locked, and the fiat payout is sent through an approved channel, such as a bank transfer. The terms should be clear before the user starts: the rate, fees, timing, and support path. If redemption is slow, unclear, or unreliable, confidence drops quickly, and regulators will ask hard questions. Different users may also need different service levels. Transferability is where a stablecoin becomes useful and where product risk increases. Users expect value to move between wallets, exchanges, merchants, and payment endpoints with minimal friction. Behind that simple action, the product must decide which rails are supported, when a transfer is considered confirmed, what happens if an address is wrong, and whether reversibility is expected. For enterprises, settlement also needs references, reporting, reconciliation, and predictable status updates. The design goal is open movement where appropriate, while still applying sanctions screening, fraud monitoring, and jurisdiction controls. Credibility is not just a UX problem. Users need confidence that each token is backed by assets they can understand, verify, and redeem against. Reserve information should be treated as part of the product experience, not hidden in legal documents. Clear dashboards can show supply, reserve mix, attestation timing, custodians, and redemption expectations. Institutions will usually need more, such as legal opinions, risk policies, and custodian details. The key is balance. Be transparent and specific, but avoid implying that disclosure removes all risk or guarantees perfect stability. Stablecoin terms should remove ambiguity before a user transacts. They need to explain redemption rights, who redeems, when, at what value, and with what limits. They should also define custody, fees, transaction finality, support channels, and dispute handling. Just as important, the product must not imply protections it does not legally provide. If balances are not insured, guaranteed, or bank deposits, say that plainly. Separate the roles of the platform: issuer, custodian, wallet provider, and payment processor. Clear boundaries help users understand risk and give compliance teams a defensible record of what was promised. Stablecoin products become valuable when they remove friction from real payment workflows. In B2B payments, that might mean faster cross-border settlement and cleaner invoice reconciliation. For remittances, marketplace payouts, or freelancer payments, it means recipients can get funds with fewer delays. Merchants may benefit from faster settlement and simpler processing. Treasury and payroll teams can automate cash movement across platforms. The key is matching the product to the job. Speed, liquidity, compliance, reporting, and user experience all matter. For enterprises, a stablecoin payment is not just a wallet sending tokens. It starts with a business request tied to an invoice, then moves through permissions, approval chains, and limits. After transfer, the product must monitor counterparties, sanctions risk, and settlement status in real time. Treasury teams also need fiat to stablecoin conversion, liquidity controls, and exposure management. The final step is reconciliation. Invoice IDs, confirmations, fees, timestamps, and exportable records must flow into ERP, accounting, banking, and compliance systems. That integration is what turns crypto rails into usable enterprise payment infrastructure. Once the use case is clear, the key question is how much you really need to own. Building gives maximum control, differentiation, and economics, but it also brings licensing, compliance operations, liquidity management, and resilience obligations. Partnering can get you to market faster, but your product quality depends on banks, custodians, issuers, and infrastructure vendors. Integrating existing rails is often the most focused path, especially for payments or treasury workflows. The best choice balances customer need, regulatory exposure, unit economics, operational readiness, and the level of trust your brand must carry. The core message is that stablecoin design is regulatory translation in action. Your role defines scope, obligations, economics, and risk. Trust depends on redemption, reserves, terms, and settlement reliability. Enterprise adoption also requires approvals, reporting, liquidity, and integrations. Next, we move from product choices into risk and compliance controls, where durable operations are built.